Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CMA Final SFM, we are continuing with the topic leasing decisions. In this class, we are going to begin with a separate section, that is leases from the viewpoint of a lessor. In the previous class, we have dealt with this topic, that is leasing decisions from the viewpoint of the lessee. In this class, we will focus on the viewpoint of the lessor. So friends, unlike lessee's case, lessor's case will be not a financing decision over here, it will be an investment decision. So when we talk about a lease arrangement is a financing decision for the lessee, but an investment decision for the lessor. Why? Because lessee is a party who is seeking some financial assistance through a lease. On the other side, lessor is a party who is investing its money to earn some income, and therefore this is an investment decision from the viewpoint of lessor. Now friends, after attending the previous class, this class is going to be little easy going. The reason obviously is because this is an investment decision. Your objective over here is plain and simple, and let me explain what will be your objective in this type of leasing decisions where you are taking the perspective or viewpoint of the lessor. Let me explain this whole thing by way of an example. Suppose I am a lessor. I have purchased an asset for rupees 40 lakhs today. And why did I purchase the asset? So that I can give it under a leasing arrangement to you. In this arrangement between you and me, I am the lessor, you are the lessee. So from my viewpoint, if you think I have purchased an asset today, I have invested rupees 40 lakhs. I am just concerned with one thing: how will I get back my money with interest? My target rate of interest is 20%. So I must get back my 40 lakhs with interest. So friends, assume that the life of the asset is 10 years. Okay. So over the 10 years time, myself, lessor, being the owner of the asset, I will be claiming depreciation expenses under tax law. When I am filing my return of income, this asset that I have purchased today, it is having my ownership. The legal title of that asset rests with me, and tax law allows me to claim depreciation expenses on that asset. As a result, what we have learnt in the name of Depreciation Tax Shield in the previous class, I am sure you remember it. The term Depreciation Tax Shield means tax savings on account of depreciation. That means it is savings in tax because of depreciation. So when I am depreciating the asset over its useful life of 10 years, every year I will be charging some depreciation, and due to that depreciation I will be getting some tax benefit. That Depreciation Tax Shield is one of my benefit which I will consider as a future cash inflow. As simple as, if I am not paying that amount of tax and I am saving that tax, it is as good as a cash inflow for me. So in financing decisions and investment decisions, we have learned one thing always: a rupee saved is as good as a cash flow earned. So here, the nature of this Depreciation Tax Shield is not a cash inflow, but a saving of outflow. So savings in tax outflow is one of the benefit that I will be getting. So friends, if the asset's life is 10 years, over 10 years time I will be getting Depreciation Tax Shield advantage, and these being the future values, I will bring down all these to present value. That means I will compute Depreciation Tax Shield for 10 years, that is throughout the life of the asset, and I will convert all those Depreciation Tax Shield amounts to their present values. Once I do that, the present value of Depreciation Tax Shield is a value that I will be recovering in the present value terms that amount I will subtract from 40 lakhs. Suppose that amount of depreciation tax shield is 10 lakhs. So I would say out of 40 lakhs of money invested today, the present value of depreciation tax shield being 10 lakhs, out of 40 lakhs, as good as I have recovered 10 lakhs. What is now the balance recovery? The balance recovery is 30 lakhs. Now there will be second component of inflow for me. That will be the terminal value of that asset. After 10 years of assets useful life getting over, definitely the asset will be scrapped out or will be sold out and will have some residual value for sure. And if there is no residual value, just forget it. But I am saying if there is some residual value, you will have to calculate terminal cash flow. In such case, just recall everything that we have learned in the first class. What you will do is, you will find out the estimated realizable value on sale of the asset. Then you will compare that with the WDV of the asset by end of its life. Difference between these two values, if any, it will result into either a short-term capital gain or a short-term capital loss. That short-term capital gain or short-term capital loss will have taxation effect. So giving the taxation effect, you will finally compute terminal cash flow. And then you will find the present value of that terminal cash flow, because if the asset life is 10 years, it is at the end of 10th year I will be getting that terminal cash flow. That value also have to convert into present value. So friends, two of my cash flow benefits which I will be getting in future, I have converted both of these into their present values, because I am investing rupees 40 lakhs today. Whatever recoveries I am making, I am also converting those recoveries in terms of present value. So let us assume that the present value of that terminal value, that is present value of the terminal cash flow, is rupees 2 lakhs. Now recollect what I have just said. From my pocket I have invested 40 lakhs today. I am getting the present value of depreciation tax shield as 10 lakhs and the present value of terminal cash flow as 2 lakhs. From 40 lakhs I will subtract both of these present values. That means out of 40 lakhs I have recovered 10 lakhs and I have recovered 2 lakhs already. Now what is the balance amount yet to be recovered? The balance amount yet to be recovered is 40 lakhs minus 10 lakhs minus 2 lakhs. That will give me 28 lakhs. That 28 lakhs which is balance recovery, now I have only one singular source, and that is the lease payments to be received from the lessee. Whatever lease payments I have to receive from the lessee, that will be my income, and that income will now be subject to tax. So if tax rate is 30% and if I am getting 1 lakh rupee of lease rental from the lessee, I will pay 30% of that 1 lakh as tax. What will be remaining in my hand is just the 70% part, that is 70,000 only. We call this as post-tax annual lease payment. All the future post-tax annual lease payments, whatever I will get, I will convert those also in terms of their present value using the same discounting rate which is my post-tax discounting rate. If my target rate of return, post-tax target rate of return is 20%, I will discount all the future cash flows to their present value using 20% discounting rate. So what I have to do is, I have to match this 28 lakhs. You understand what is this 28 lakhs I am talking about, right? 40 lakhs is the money invested from my pocket today. 10 lakh is the present value of depreciation tax shield and 2 lakh is the present value of terminal cash flow. This much I am recovering through other means. Balance 28 lakhs I have to recover from the lessee. And what should be that 28 lakhs? That 28 lakhs should be the present value of post-tax annual lease payment. I repeat, that 28 lakh should match with the present value of post-tax annual lease payments. Once as a lessor I know this objective of mine, accordingly I will set out how should I recover this money from the lessee. That means now I have to set a pattern of recovery. I will have to sit across the table with the lessee. In this example, if I am lessor, you are lessee, both of us will sit across and we will plot that this will be the pattern of lease payments. Suppose you say that, dear lessor, do not charge so much of lease rentals initially because it will be a new business for us. Please charge lesser rentals. Later on you can increase the rental amounts. That means you are seeking a stepped up arrangement. Alternatively, you can seek a constant payment mode. You can have initial few years out of 10 years of lease, you can have initial 2-3 years as relaxation period, and then the lease payments will begin. We can have multiple types of arrangements between the lessee and the lessor. However, all these arrangements will have one common point, that is the present value of post-tax annual lease payments must match with 28 lakhs as per this example. So friends, if you are just going to concentrate on a very important example that I am taking in the form of a question, you will understand the whole concept through that one question. That is my promise. What I want from you is complete attention, and as and when we are progressing ahead, I will deal with different types of patterns of lease payments or different arrangements one by one, and I have clubbed all these things in one single question, which is question number 10 in your textbook. So once I start with that question, through that question I'll explain everything one by one, and let us just begin with that question. Let us move to question number 10 of the textbook. Let us read this question. X Limited acquired an asset at a cost of rupees 35 lakhs. This asset is given under a lease contract to Y Limited for 5 years. Depreciation rate under tax law is 20% per annum on WDV basis. The estimated scrap value of the asset at end of 5 years is rupees 12 lakhs. The required rate of return for X Limited is 15% per annum. This rate can be considered as a post-tax discounting rate for the company. Tax rate is 30%. The amount of lease payments to be charged by X Limited to Y Limited over 5 years has to be negotiated. Determine the amount of pre-tax lease payments to be recovered by X Limited under following arrangements. Now friends, you will see that the question demands 7 different arrangements in this whole scenario. In examination, you will not be asked so many arrangements altogether in one question. Maybe 2 to 3 arrangements they can ask at the max. However, because we are having an objective to learn the entire situation through this one example, that is why we are targeting 7 different arrangements. So friends, even if I read out these 7 arrangements given in this question, it will not make any difference right now. What we will do is, we will first plan the solution of the question for the initial part, and then we shall move to these 7 arrangements one by one. So let me take you back to the early part of the question and let us discuss something important over here. In this question, if you see how much money has been spent initially for acquiring the asset, that is 35 lakhs. Now this becomes your starting point. Rupees 35 lakhs is one of your initial investment. As I have explained earlier, what you will now do is you will trace the depreciation and compute depreciation tax shield, and then the present value of that depreciation tax shield. So depreciation rate under tax law is 20% per annum on WDV basis. So you know how to apply WDV basis. All these basic things we have learned in the earlier class. So what you will do is, you will compute depreciation on WDV basis for all the 5 years, and then using the informed tax rate, which is 30%, you will compute depreciation tax shield. Depreciation tax shield once computed, you will then convert this into the present value, and finally what you will get is the present value of depreciation tax shield. Secondly, the scrap value of the asset by end of its economic life is given as 12 lakhs. After charging depreciation for 5 years on WDV basis at 20% per annum, you will also obtain WDV of the asset. maybe that such WDV of that asset doesn't match with this estimated scrap value, and therefore there will be some capital gain implications and some short term capital gain or short term capital loss might arise, and there will be some tax effect on that gain or loss. Considering all that, you will compute terminal cash flow and also the present value of that terminal cash flow. Finally, once you get that, from 35 lakhs you will subtract two things. Number one, that is the present value of depreciation tax shield, and number two is the present value of terminal cash flow. So friends, let us do one thing. Let us begin with the solution by first approaching the calculation of depreciation tax shield and terminal cash flow and their present values. Let us see how to write up that part of the solution. So friends, as I have mentioned, in your solution you will first compute DTS, that is depreciation tax shield, and present value of depreciation tax shield. So simply make a small table for this purpose. You will plot the 5 years calculation of depreciation using 20% per annum rate on WDV basis. I am sure I don't have a need to explain you how we got these depreciation amounts. You are a CMA final student and you have learned these depreciation calculations always in your studies. In the earlier class also I have explained. Let me just still show you. This 7 lakh is 20% of 35 lakhs. Because the method of depreciation is WDV method, from 35 lakhs you will subtract 7 lakhs and the remaining value will be then 28 lakhs. On 28 lakhs you will again charge 20% depreciation, giving you 5,60,000 and so on. I have explained you a shortcut of making this calculation, that is 5,60,000 basically will be 80% of 7 lakhs. Because the rate of depreciation is 20%, the written down value will be 80%, and therefore each year's depreciation will be 80% of the earlier year. So basically, once you get depreciation of 1 year, keep on computing 80% of each previous year and you get that current year's depreciation. Now depreciation tax shield will be 30% of the amount of depreciations, right? So tax rate is 30%, so depreciation tax shield will be simply 30% of these amounts, and you can easily compute that. Then the targeted rate of return, which is the discounting rate for the lessor, is 15% as informed in the question. So what you will now do is apply 15% discounting rate and compute PV factors for 5 years. Each PV factor will be multiplied to their respective DTS of that year, and finally you get present value of DTS. So first year the PV factor is 0.869565. How we got this? It is 1 divided by 1.15. It is the present value factor of 1 rupee for 1 year at 15%, correct? You have learned these calculations, time value of money. Now this calculation, that is PV factor applied on depreciation tax shield, what you get is the present value of depreciation tax shield. Likewise, you will make calculation for each of these years, and finally after 5 years calculation getting over, you are going to take the total of depreciation column and total of present value of DTS, these two columns. What will you do with this? With the help of this, you will get to know what will be the WDV of the asset by end of its life, so that you can compute at the end whether there is any capital gain or capital loss. And why do we need total of this column? We need total of this column so that present value of depreciation tax shield will be reduced from the initial investment to find out what is the balance amount to be recovered. Now this total is 5,02,251. So friends, before I take you ahead, I want you to carefully note down all these calculations, because next question onwards you are going to do these calculations on your own without my help. Alright friends, you would have finished writing this whole thing. Let us move ahead and take another calculation, that is the calculation of terminal cash flow and its present value. Now what we have learned how to do this calculation, the expected sale value of asset by end of its life is rupees 12 lakhs given in the question. WDV of asset by end of its life will be the original cost of the asset minus the accumulated depreciation or the total depreciation throughout the life, and that WDV comes to 11,46,880. Now you are selling the asset at something more than its WDV, so obviously the resulting amount will indicate a short term capital gain, and because there is a short term capital gain, you will be subject to tax on such short term capital gain. The short term capital gain tax will be charged at the usual tax rate of 30%. 30% of 53,120, that is 15,936. And finally, when you compute the terminal cash flow, 12 lakh which was your scrap value estimate, from that you will subtract the tax payable on short term capital gain, and the final net cash flow what you get on termination will be 11,84,064. We would want to find the present value of the same, so the PV factor for 5th year shall be applied on this, and finally the present value of terminal cash flow comes to 5,88,689. So friends, do one thing, please carefully take note of this whole calculation and then we shall move ahead. Alright friends, after writing up this working, we are ready to make a small but a very important calculation, and that is when you start with the cost of the asset, that is rupees 35 lakhs. From this you will subtract the present value of depreciation tax shield as well as the present value of terminal cash flow, and what you get is the balance to be recovered in the form of present value of post tax annual lease payments, and that is rupees 24,09,060. Now friends, let me explain this whole calculation once again. This is the amount that the lessor has invested initially. Depreciation tax shield and terminal cash flow are the two benefits that the lessor will be obtaining in these forms, and finally the present value of these benefits have been subtracted from this initial investment. That means out of 35 lakhs of investment, 24,09,060 rupees is yet to be recovered, and now the only way to recover this is to collect lease payments from the lessee. The lease payments will be subject to tax. That means what lessor will finally get in hand is the post-tax annual lease payment, and the present value of these post-tax annual lease payment has to match with this amount. I want you to carefully understand this and note it down, and then I take you ahead. Alright friends, you would have finished writing this calculation. Let me take your attention back to the question and focus on this part of the question where the question is asking you determine the amount of pre-tax lease payments to be recovered by X Limited under following arrangements. So basically X Limited is the lessor and Y Limited is the lessee. So how much X Limited should charge to Y Limited under following arrangements, and there are 7 different arrangements given, and let us do one thing, we should focus on one arrangement at a time. So let us first focus on the first arrangement. So it says equated annual plan under which X Limited will recover a constant amount at end of each year. Let us now move towards the solution and let us see how to present the solution. You will first write determining pattern of lease payments under each plan, and starting with the first plan, that is equated annual plan, where annual amount of lease rentals will be collected at end of each year. And this being equated annual plan means each of the lease payment made every year end will be same amount. That means the amount will be constant. Each year end, same amount will be paid. That is the idea. Now what you do is, let post tax annual lease payment be rupees X. Now we don't know how much rent has been fixed or how much lease payments have been fixed. We know one thing, that we have assumed the post tax lease payment to be X. Now we know one thing, that if the lease payments are made at end of each year, that being constant amount, you can apply annuity. So PV of annuity at 15% for 5 years can be computed as 3.352155. If this is the annuity factor and this is the post tax lease payment every year, the present value of post tax lease payment will be X multiplied by this amount, correct? And multiplying these two, what you will get is 3.352155X, and that amount should match with the amount to be recovered in the form of present value of post tax annual lease payment, what we have shown in the earlier working. Solving this equation, you can get the value of X, and the value of X indicates post tax annual lease payment of each year. And to convert that into pre-tax annual lease payment, the task is very simple. This is the post tax lease payment. Post tax will be 70% of the pre-tax lease payment. That means if this is 70%, what would be 100%? So what you would simply do is find pre-tax annual lease payment by taking post tax annual lease payment divided by 1 minus tax rate. Finally, you get pre-tax annual lease payment for the first part of the question as 10,26,657 per annum. So friends, this is just the first part of the arrangement. Write down this whole thing and then I take you to the next part. Alright friends, let us move ahead and now read the next part of the question. What is being asked? The second part. Equated annual plan under which X Limited will recover a constant amount at the beginning of each year. Now, can you notice one thing? The only difference in the first part and second part, here in the first part it was asked as end of each year. It was constant amount each year but end of each year. Here again it is constant amount each year but at the beginning of each year. Just time value of money will play its role over here. Instead of annuities at end of each year, now it is annuities at beginning of each year. Now friends, a simple trick that you may apply over here is, the lease term is 5 years, and if it is 5 installments which will be recovered at the beginning of each year, we will consider this as the first payment will be considered as down payment, because it is paid at the beginning of first year, means it is an upfront payment, and that being an upfront payment, it will be considered as a down payment. That down payment we will simply consider at 0 year, and then each year we will recover the same amount. That each year payment will be considered as year 1, 2, 3, 4, because when we say year 1, it is end of year 1. So friends, over here please observe one thing, how would you present your answer so that neither there is any confusion nor there is any doubt. You should be very clear with this calculation. And one word in examination, that is beginning of the year and end of the year, change of one word can change the entire solution. So make sure that you commit no mistakes and see how to present the solution of this part. The second part, equated annual plan, where equal amount of lease rentals will be collected at beginning of the year. Now, if 5 installments are payable at beginning of each year, it implies down payment plus 4 installments. Applicable annuity factor will be 4 years annuity plus 1. Why? Because for the down payment, the present value factor will be 1. Why? Because present value of rupee 1 at present will have to be rupee 1 only. As a result, you compute 4 years annuity factor, and to that you simply add 1. So 4 years annuity factor at 15% will be 2.854978. To that you simply add 1, and what you get is 3.854978. So friends, do one thing, write up this calculation and then I take you ahead. Alright friends, you would have finished writing this calculation. Let us move ahead, and in that same second part you would continue to write, let post-tax annual lease payment be rupees X per annum, and now the annuity factor what we have determined earlier when multiplied to X should match with the present value what we have computed earlier, that is 24,09,060. One thing that you should note, no matter what is the arrangement, it is this amount which must match with the present value of post-tax annual lease payment. If you are keeping this amount matching with the present value of post-tax annual lease payment, you will get your objective fulfilled. So when you solve this equation, what you get is X equals to 24,09,060 divided by the factor, that is 3.854978, and finally solving this you get the value of X as 6,24,922 per annum. Now this is post-tax annual lease payment. To convert that into pre-tax annual lease payment, what you will do is divide the same by 1 minus tax rate, and what you get is pre-tax annual lease payment as rupees 8,92,745 per annum at beginning of each year. So friends, this is the answer for the second part of the question. Please take note of this and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Let us move ahead to the third part of the question, which is asking you to apply a deferred plan under which no payments shall be made by Y Limited in the first and second year, and thereafter equal amounts shall be recovered by X Limited at end of each year for the 3 remaining years. So friends, under this third plan, no payment shall be made in the first and second year at all, and in the third, fourth and fifth year end equal payments will be made. So how would you now set up your equation to recover that present value? What you will do is you will make a calculation of present value separately, plotting year 1, 2, 3, 4, 5. Because no payments will be made in year 1 and 2, the post-tax annual lease payment of year 1 and 2 you can take as 0 and 0, and for the later 3 years you assume that the post-tax annual lease payment will be rupees X each year. So in the post-tax annual lease payment column you would write 0 0 for the first 2 years and X X and X for the later 3 years, and then apply the PV factors to these cash flows in form of post-tax annual lease payment. Apply PV factors, you finally get the present value of post-tax annual lease payment and equate with that amount what you have computed, 24,09,060, and once that equation is set you get the value of X. What you get as X, don't ever forget, it is post-tax annual lease payment, then convert the same into pre-tax annual lease payment. So let us see how to present the answer. In the solution to the third part, you would write deferred plan under which no payments shall be made in first 2 years. Let post-tax annual lease payment be rupees X, and finally when you plot the calculation for 5 years, year 1, 2, 3, 4, 5, the post-tax annual lease payment for the first 2 years, as I have told you, you would take 0 and 0, and the later 3 years you will take X, X and X. PV factors at 15% you plot for each year and multiply these PV factors to post-tax annual lease payment, and finally take the total of that last column, and what you get is 1.726446X. It is this amount which should be equated with the targeted recovery in the form of present value of post-tax annual lease payment, which is the amount of 24,09,060. So first write up this much and then we proceed ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the remaining calculations. So as I have said, 1.726446X will be equated to the targeted amount, that is 24,09,060. and when you solve this equation you get the value of x as 13,95,387 per annum. And don't forget, this is post tax annual lease payment. So converting this into pre-tax annual lease payment, that will be 13,95,387 divided by 1 minus tax rate, that is 1 minus 30%. So it effectively becomes 13,95,387 divided by 0.7, and what you get is 19,93,410 per annum, and this will be the amount payable at the later 3 years, where the first 2 years no payments shall be made. So friends, write up this also, and that will be completion of the third part of your question. Alright friends, you would have finished writing this whole thing. That was the answer for the third part. Let us move ahead and read the fourth part given in the question. The fourth part over here says, stepped up plan under which X Limited will recover lease rental in such a pattern that lease rentals for each year is 10% more than the lease rental of previous year, and payments are to be made at end of each year. So friends, answering this fourth part of the question, what it simply requires is you have to understand the stepped up arrangement. If you are paying 1 lakh rupees of rent in the first year, the second year's rent will be 1,10,000, that is 10% more than the first year. Third year rent will be 10% more than the second year's rent, and this is how the pattern of stepped up lease payment will be arranged. So to handle this question, what you will do is, this time you will not write the line that let post tax annual lease payment be rupees X, because it cannot be XXX each year. Instead what you will do is, let the post tax annual lease payment for the first year be X. So the first year post tax annual lease payment is X, second year post tax annual lease payment will be 10% more than X, so we can write 1.1x. Next year it will be further 10% more than the second year's payment. You will again multiply 1.1 to the second year's payment or second year's post tax annual lease payment to arrive at the third year amount, and so on. Once you get for all the 5 years the amount of post-tax annual lease payment, then you multiply the respective PV factors for each of the 5 years, and finally what you get is the present value of post-tax annual lease payment, which you again have to equate with that same target amount, that is 24,09,060. So friends, let us see how to write up the answer. So friends, in this part of the solution you would write stepped up plan under which lease payments for each year is 10% more than the previous year, and what you would do is make up a table again, and as I told you, year 1, 2, 3, 4, 5, and you consider the post-tax annual lease payment for the first year as X, second year it will be 1.1x, third year it will be 1.21x, fourth year it will be 1.331x. This has been set in such a way that each year's lease payment is 10% more than the previous year. Now, don't forget that this column what you have targeted is the post-tax annual lease payment. PV factors at 15% will be written over here, and each of these PV factors will be multiplied to the respective post-tax annual lease payment to get the present value of post-tax annual lease payment. And this last column is having an aggregate value of 3.985838x, and as I told you earlier, this final amount needs to be matched with the target amount of recovery in the form of present value of post-tax annual lease payment. So this is present value of post-tax annual lease payment, and as per the first initial calculation that we have made in this question, this also is to be recovered by way of present value of post-tax annual lease payment. So friends, what you do is just equate these two, and ahead in the solution we will find the value of X. X will be the post-tax annual lease payment for the first year. We will convert that into pre-tax, and then whatever amount you get will be the pre-tax annual lease payment of the first year. Then you have to accordingly find the values for second, third, fourth and fifth year also. But first what you do is write up this whole calculation. Alright friends, you would have finished writing this whole calculation. Let us move ahead and now write the value of X, which will be 6,04,405, which will be the post-tax annual lease payment for the first year. Convert that into pre-tax annual lease payment, which comes to 8,63,436. Once you get any 1 year's pre-tax annual lease payment, you can easily work out the later year's pre-tax annual lease payment by simply adding 10%. So if you can see what we have done, this amount is 10% more than 863,436. Then on this, when you add 10%, you get 10,44,757. Again on that you add 10%, again on that you add 10%, and you get all 5 years pre-tax annual lease payments. So friends, write up this whole thing and that will be the answer for fourth part of the question. Alright friends, you would have finished writing this whole thing. Let us move ahead and now read the fifth part of the question. In the fifth part, what is given? Ballooned plan under which all payments shall be made only on termination, that is at end of fifth year. So friends, how would you deal with this? Very simple thing. You would consider the annual lease payment, that is post-tax annual lease payment of fifth year as X, multiply the PV factor of fifth year to that post-tax annual lease payment and equate that with the targeted amount. So this is going to be simple. Balloon plan under which payment will be received only at end of fifth year. So PV factor at 15% of fifth year is 0.497177, and let post-tax annual lease payment for fifth year be X. X multiplied by PV factor should be matched with 24,09,060. And always I have been telling you one thing, that this is the target amount to be recovered in all 7 parts of the question. It is this amount which is being applied all the time. So value of X can be easily determined. Whatever be the value of X, it represents post-tax annual lease payment for the 5th year. This will be the only payment, but this being a post-tax payment, you convert that into pre-tax by dividing it by 1 minus tax rate, and finally what you get is 69,22,111. Now this will not be written as per annum, this will be a singular payment made at the end of the lease term, that is at end of 5th year. So friends, take note of this whole thing, and that will be the answer for 5th part of the question. Alright friends, you would have finished writing this whole thing. Let us move ahead and deal with the 6th part of the question. 6th part of the question reads as follows: modified ballooned plan under which X Limited shall recover lease rental of rupees 10 lakhs at end of 4th year and balance at end of 5th year. Now friends, this is just similar to balloon plan. Now in this modified balloon plan, there will be one additional payment made at end of 4th year. So let us see how to solve this part. Modified balloon plan, what you would do is, what is unknown is post-tax annual lease payment for 5th year, that will be X. Now the 4th year amount you know already, but friends, what is given in the question as rupees 10 lakhs, is the pre-tax amount. Okay, don't write that amount over here. Year 1 to 3 I have written 0, 0, 0. Do you notice one thing? In the fourth year we have written 7 lakhs over here, because this column indicates post-tax annual lease payment, and post-tax annual lease payment will be 7 lakhs, because if pre-tax amount is 10 lakhs, 30% of 10 lakhs will be representing tax, and the post-tax annual lease payment for fourth year will then be considered as 10 lakh minus 3 lakh, that is 7 lakhs. And for fifth year the amount is not known, we have kept it as X. What we do then is we write up all the PV factors at 15%, and then we multiply these PV factors to these post-tax annual lease payments, and what we finally get is this amount as present value of 7 lakh and this amount as present value of this X. The aggregate of this present value will be 4 lakh 227 plus 0.497177X, and it is this amount which will then be equated with 24 lakh 9,060. But before we do that, quickly write up this much. Alright friends, you would have finished writing this whole thing. Let us move ahead and now find the post-tax annual lease payment for fifth year, that is the value of X. And for that purpose what you will do is, whatever was the present value total, we will equate that with the target amount, that is 24 lakh 9,060, and when you do that you get the value of X. Value of X is 40 lakh 40,479, which represents post-tax annual lease payment for the fifth year. And to convert that into pre-tax amount, you simply divide that by 1 minus tax rate, and what you get is 57 lakh 72,000 113. So friends, take note of this as well, and that will be answer for sixth part of the question. Alright friends, you would have finished writing this whole thing. Let us move ahead and now deal with the last part of the question, which is talking about deferred cum stepped up plan, under which no payments shall be made for the first 2 years and lease rentals shall start from third year, and lease rental in each year will be 10% more than the lease rental of previous year. So friends, again this is not any new plan, it is mix up of deferred plan and stepped up plan, and I am sure without my help also now you can solve it easily. Let us see how to present the solution over here. You will write the heading as deferred cum stepped up plan. Let the post tax annual lease payment for third year be rupees X, because in first year and second year there will be no lease payments at all. So you write the similar kind of table, but here what you should do is first 2 years there will be no lease payments, so post tax annual lease payment will be 0 and 0. Later 3 years it will not be X, X and X, because the payments will not be constant. Payment of each year will be 10% more than the payment of previous year. So if third year it is X, fourth year it has to be 1.1x, fifth year it has to be 1.21x. Then you will plot the PV factors as usual, multiply with the post tax annual lease payment these respective PV factors, and when you take the total of present value of post tax annual lease payment, whatever you get over here 1.88000647x, this needs to be equated with the target amount of 24,09,060. But before we do that, write up these calculations quickly. Alright friends, you would have finished writing this whole thing. Let us move ahead and determine the value of x by equating 1.888000647x equals to rupees 24,09,060. What you get by solving that equation is the value of x, which represents post-tax annual lease payment for third year. So you convert that into pre-tax annual lease payment for third year, and once you get this, 10% more of this value will be the pre-tax annual lease payment for fourth year, and 10% more than that will be the payment for fifth year. So friends, take note of this whole thing, and that will be end of the solution.